this graph, a lot of the ways accounting is done is based on how risk changes over time for life insurance. So how does time impact risk? So this first line shows risk for a relatively healthy individual who has purchased a life insurance policy. Risk starts out low, beginning, and over time it increases as they get older. Next, the blue line shows a relatively unhealthy individual, so risk is higher and then slowly increase over time. But for life insurance, it's unique is at the end of the day, the claim will always be paid out in the majority of life insurance policies. And so you can see risk ultimately comes to a point. And a lot of the way the accounting is done is based on this concept. It's how they account for premiums, reserves, and claims is how risk changes over time. One thing to note too is life insurance usually covers a long period of time. And so that a lot of the way that's accounted for is over that long period and how they account for that. Here are common types of life insurance policies. First is term life, this policy that covers you for a set period of time. Usually it's 10, 20, 30 years. And at the end of the period, if you haven't passed away, it does end. If you pass away during it, you get paid out. Permanent life or whole life provides, well, there are two types of permanent life. There's whole life, and it provides permanent coverage that lasts a lifetime, as well as a guaranteed premium and cash value. So this is no specific set of time. There's a set premium amount, you pay over time, and you can accumulate cash value of the policies. Next permanent life is universal life, and this is similar, but it provides more flexibility than whole life. Next is limited pay life. So lifetime of benefits, not a lifetime of payments. So there's a certain point in time you pay for policies and then you stop those payments, but the benefit is always there.